International Accounting Standard 1. That is IAS 1. And what does IAS 1 say? It says presentation of financial statements. Presentation of financial statements. In case you're wondering, what are these standards? The International Financial Reporting Standards are high-quality standards that are issued by the International Accounting Standards Board. As of date, we have about 19 IFRSs, and then we have some existing IAS. So, if you say IAS and you say IFRS, together, this is what we call IFRS. Okay? So, the International Accounting Standards, that was the name that the standards were called in the past. But as at present, they are now called the International Financial Reporting Standards. And so, all the IASs that were issued before are relevant in as much as they have not been replaced. So, if you talk about IAS 1, for instance, you say presentation of financial statement. You talk about 2, you talk about inventory, and so on. Now, if you also want to look at the IFRSs, you could just say the first one is first time adoption. First time adoption of IFRS. You could say 2, share-based payment. You could say 3, you could say business combination. Nation. You could say 4, insurance contract. You could say 5. You say non-current assets held for sale and discontinued operations. You could say 6. You can say exploration for, and evaluation of mineral rights. You could say 7. You could say financial instruments. Disclosures. And 8, operating segment. 9, financial instrument. This is disclosure of financial instrument, and this is financial instrument. Anyway, that is not what I want to teach today, but I was just trying to show you that it is very important for you to have a rock solid knowledge of your standards, because for you to understand the financial statements, or for you to know how to prepare financial statements, you must know the standards, you must know accounting principles, you must know accounting rules like the gaps, and then you must know your formats. Now today we want to look at presentation of financial statements. These financial statements has an objective. And what is the objective of the financial statement? The objective is to prescribe the basis for general purpose financial statements. Now, what do we understand by general purpose financial statements? These are statements, financial statements, that are general in nature. In other words, they cater to the needs of general users. They also follow standards. So, This is what we mean by general purpose financial statements. They follow standards and they have a wide range of users. And also they have a pattern that you must follow in preparing them. So they are called general purpose financial statements. Now, what is the basis? The statement, the accounting statement, the accounting standard rather, prescribes two bases. One is the accrual basis. What is accrual basis? Accrual basis is simply saying that you must recognize financial transactions or financial events in the period in which they occur and not when cash is paid or when cash is received. You recognize financial transactions in the period in which they occur, not when cash is received or paid. In other words, if you do some work, you render services, or you make some sales for this period and you have not been paid, you make those sales, or you offer those services on credit. When you are preparing your financial statements, you will put in the figure that you have earned, even if you have not been paid for it. You may be paid 2 years from now, it doesn't matter. But when preparing your account on accrual basis, you will put in that amount because you've already earned it. So the financial transaction, the financial event is recorded in the period in which it occurred, which is this year, and not next year or 2 years later when cash was actually paid. The second basis is what we call going concern. Going concern. Now, this is a very, very important concept. It is an assumption that the entity which is being reported on has no plans to cease operations, and that it will not be seized, it will not be forced to cease operations. In other words, it has no plan to liquidate, and also it will not be forced to cease operations. You know, the owners of the business may decide to liquidate it. Also, government or other forces may force it to cease operations. So when you are preparing accounts under IAS 1, presentation of financial statements, they are prepared under these two bases. First is the accrual basis, and the second one is the assumption that the business is a going concern. Usually, it is good to test for going concern. You test for your going concern, whether there's a going concern issue. A company may have going concern issues, and the company may not be aware of it until it carries out a test. Now, how do you know that a company has going concern issues? Let's look at just one or two examples. Number one, you may be unable to meet your financial obligations. Maybe you have some loans that you've taken and you are not able to service those loans. In that case, it may constitute a going concern issue, especially if it is material. Materiality has to do with the ability. In other words, something that can influence your decision. If you have choices, you have A, B, C, the information you have or you do not have. In other words, we say if an information is material, if the non-disclosure of it, the non-provision of that information can affect your decision. So if you have that information, you may make a different choice. So any information that can change your decision is said to be material. If the information cannot change your decision, then it is not material. All right. Now, having looked at this, what are the accounts, the statements to be prepared? The first one is the statement of financial position. The statement of financial position. This statement of financial position is what everybody knows. We call it the balance sheet. That sounds familiar, huh? The balance sheet is a statement of financial position. It tells the user of the account what the financial position of that entity is as at a period of time. So for statement of financial position, usually when we prepare it, we say statement of financial position as at, because we're looking at that entity from when it began to exist, from when it was created, from that time to date. So we're looking at the statement of financial position. Another one is what we call the statement of profit or loss and other comprehensive income, OCI. Statement of profit or loss and other comprehensive income. Now, this is what we used to call in the past. We used to say, some will say profit and loss account. That is so outdated. There's nothing like profit and loss. You cannot make profit in a period and also make a loss in that same period. This is a measure of performance. It's a measure of performance. And it's done for a period. It is not as at a period. It is done for the year ended. So if you are looking at this year, 2025, for instance, you'll be looking at from January to December, if it is a fiscal period of January to December that you are looking at. Then you are looking at from January to December, 31st December of this year. So when you do that, you are trying to measure the performance, whether the company is making a profit or making a loss. Now we say statement of profit or loss and OCI. The standard allows us to break this statement into two. You could prepare one and call it the statement of profit or loss, and prepare the second one, which we call the statement of other comprehensive income. Or you are at liberty to prepare it as a single statement, where you call it statement of profit or loss and OCI, that is other comprehensive income. Now, what is income? Sometimes it is not a profit you make there. It might not be an income you make. That's what I mean. Okay, we'll talk more about that when we start looking at it. We'll look at them one after the other. All of these statements, we'll look at them one after the other, and then we'll also get to do some professional examination questions to talk about them. The third one is what we call statement of changes in equity. This statement of changes in equity talks about the equity. Equity refers to the owners, the ordinary shares of the business. Ordinary shares of the business. Now, the capital that is invested in the company or in the business can also change. So when that happens, we look at the statement of the changes. What can make it change? It might be retained earnings that has been transferred into equity. It might be revaluation surplus that has been transferred. We also have the statement of cash flows. The statement of cash flows. We also look at the statement of cash flows. There's the direct method and there's the indirect method. So we'll look at both of them. And this tells us the inflows and the outflows as far as cash is concerned. So we're going to look at the operating activities, we'll look at the investing activities, and we'll also look at the financing activities. And lastly, not the least, we'll talk about the notes to the financial statements. If you have not subscribed to this channel, I urge you to do so. Call your friends who want to be chartered accountants, anybody who is learning accounting in school. Even if you're a professional accountant, try to be up to date, sharpen your skills, and make sure you are on top of your game. So in this accounting and coaching class, yes, this is a class where we coach you, accounting and finance coaching class. It's very important that you continue to share our videos. It's also important that you continue to follow our videos and make comments so that we can be encouraged to give you more. Thank you, and see you.